Welcome back to the channel. My name is Brad, and today I'm going to post a audio recording of Steven's latest article on Seeking Alpha. I'm also going to link the article down below, and it will be a free link. So you don't have to be a member of Seeking Alpha to go read the article if you want to, and you may not want to. And to entertain you, or keep your eyes busy while you're listening, I'm going to share pictures of my dog and her grand adventure, because my dog has put her paws into the Atlantic Ocean and the Pacific Ocean. Most people themselves can't even say they've done that, but somehow my dog has been able to do that in her lifetime. Hope you enjoy this episode.
Betting on corporate America to muddle through whatever lies ahead. This article was written by Stephen Bavaria. Summary: credit investing is like betting on horses to merely survive the race and make it around the track. Equity investing is like betting on horses to win, place, or show. Credit bets are a lot easier to win than equity bets. If I can make an equity return on a credit bet, I'll do it every time. In turbulent, uncertain times, I like betting on the leaders of corporate America to muddle through and make sure their companies survive, even if their equity goes into the tank. When I first introduced the Income Factory here on Seeking Alpha, I was called a heretic. Now thousands of my readers describe how they sleep better at night through market downturns. Income investing. Boring can be beautiful. Most of my readers know by now that my approach to investing is pretty boring. It hasn't always seemed boring, because when I introduced my Income Factory strategy about a decade ago, I got a lot of pushback and criticism from readers who had been trained over many years to believe that growing their wealth over the long term required them to invest in growth stocks, whose total return depended primarily on achieving capital gains. I was considered a heretic for pointing out a simple mathematical truth. If the total return of an asset, be it stock, bond, real estate, etc., consists of both, 1, the cash it produces during a period of time, month, year, etc., plus 2, the capital gain or loss incurred in holding it during that time period, i.e., how much its market price goes up or down, then it makes no difference which of those two sources contributes to the total return, or by how much. In other words, math is math. And an asset that earns a cash yield of 10% and has a capital gain or loss of 0% generates a 10% total return, just as much as an asset that generates a 0% cash yield and has a capital gain of 10%. Similarly, an asset that generates 5% cash yield and increases in value by 5%, it also generates a 10% total return, and so on. Once investors realize that, then they also realize that they have more choices for how to earn their target investment returns than they may have been told originally by their investment mentors or advisors. Obviously, the traditional strategy of investing in growth stocks is still a good way to grow one's wealth over time. The long-term rate of return on equities over the past century or so has been about 9 to 10%. Anyone who invested in the S&P 500 index, SPY, and held it patiently since its inception 30 years ago would have had an average annual total return of just over 10%. To put that in perspective, a 10% total return, reinvested and compounded year after year, would double and redouble itself about every 7.2 years. So after 28 years, it would have reached about 16 times its starting value, and by 35 years, it would be about 30 times its starting value. Most of that would have been provided by capital gains, not by cash dividends. The current cash dividend yield of the S&P 500 is 1.2%. That means anyone who invests in it expecting to earn its long-term average rate of return, i.e., 10%, must be planning to achieve average annual capital gains of over 8% in order for their total return to be between 9 to 10% when the two components, 1.2% cash yield and 8+% capital gain, are added together. The key word in that paragraph is average. It is easy to pursue patiently a buy and hold index strategy in years when the market is cooperating, and you actually earn your average 8% capital gain. But when the market is flat or down, It can be challenging to hold tight while you are only collecting 1.2% in cash and the market value of your portfolio is going nowhere or falling. It is at that point that investors often bail out or take other defensive action that ends up hurting them in the long run, like going to cash or exchanging equity for more stable assets that end up earning a lot less. Another investment theme: sleeping at night. It is because I am the first to admit I don't have the patience to sit quietly and collect 1.2% per annum in cash while watching my principal go nowhere or even drop in price, that I evolved to what ultimately becomes my income factory strategy. First, I began buying higher yielding equities, especially utilities, infrastructure, and other higher yielding but slower growing equities. When I did notice that my cash yields were higher than they'd been previously, but I also noticed my stocks weren't growing as much or as fast during rallies as the growth stocks I previously owned. Then I began to seek out even higher yielding assets, especially credit assets. This was a natural development for me since I'd spent much of my career in banking and credit and knew that major institutions, banks, pension funds, endowments, etc., were often able to earn equity or close to equity returns from various types of credit assets. I found many of these asset classes were available to retail investors if we looked around for them, and that they paid higher rates if we bought them in less liquid vehicles, like closed-end funds, where we had the advantage of having more assets working for us than we sometimes actually paid for because of discounts, and because the fund could sometimes leverage our investment at cheap institutional interest rates and terms unavailable to the typical retail investor. More details here. Examples of the sort of investments I'm talking about are corporate loan, high-yield bond, and other corporate credit funds like Ares Dynamic Credit Allocation Fund, ARDC, paying a distribution yield of 9.26%. Invesco Senior Income Trust, VVR, paying a distribution yield of 13%. XAI Octagon Floating Rate and Alternative Income Trust, XFLT, paying a distribution yield of 14.9%. Carlyle Credit Income Fund, CCIF, paying a distribution yield of 15%. KKR Income Opportunities Fund, KIO, paying a distribution yield of 10.2%. The result of all this was my income strategy based on the idea of achieving long-term equity returns of 9 to 10% or more by creating our own growth through reinvesting and compounding high cash distribution streams, and no longer being dependent on market price appreciation as our engine of growth. I am very grateful that so many readers have accepted and embraced our strategy, not because it is any better than a traditional equity growth approach, but merely as a legitimate alternative for investors who do not want or do not have a strong enough stomach for a strategy that has so much volatility from one period to the next because it depends largely on capital gains to generate its total return. A strategy for troubled times. Besides being a good alternative strategy for normal times, I think unusually uncertain times, like we are currently experiencing with our political, geopolitical, and economic challenges, make a cash-dependent rather than growth-dependent strategy even more appealing. To put it more plainly, the more uncertain the overall investing environment becomes, the more I prefer credit to equity. As described in detail elsewhere, I think of credit investments, loans, bonds, debt in general, etc., as taking an existential risk. Will the issuer survive and pay its debts? I think of equity investing as taking an entrepreneurial risk. Will the issuer grow its earnings and dividends and become a more valuable entity, so its stock will be worth more in the future than it was when you bought it? What is interesting is that equity investing also includes the existential risk along with the entrepreneurial risk. An issuer can't thrive and grow its earnings and dividends if it doesn't first survive and pay its debts. So when you invest in the equity of a company, you are also taking all the risk of an investor who only buys the debt. If that company doesn't pay its loans and bonds, then its equity will be worthless. This issue sometimes comes up when I discuss how I like to buy funds that invest in corporate loans and high-yield bonds, which often pay distribution yields in the 9 to 10% and higher range. And investors will say, high-yield bonds? That's junk. I'd never buy that. It's too risky. Then I point out how so-called junk bonds or loans merely means debt issued by non-investment grade companies, which are companies rated below BBB. In fact, the majority of all companies are rated non-investment grade. That includes almost all mid-cap and small-cap companies. So the next time an investor tells you they would never buy high-yield bonds or loans because they are so risky, ask them if they own any small-cap or mid-cap equity funds. In most cases, the answer is yes, we do, which means they own the riskier equity of companies whose debt they say they'd never own. Skin in the game for CEOs equals money in the bank for credit investors. Besides writing about income investing, I also wrote a book called Too Greedy for Adam Smith, which is about how excessive CEO pay has become an outrageous perversion of capitalism within the US economy. CEOs sitting on each other's boards of directors and setting each other's pay is the sort of conflict of interest that our laws and corporate governance policies, in theory, are supposed to prevent. But this huge loophole, which has allowed corporate CEO pay to skyrocket to heights that no arm's-length system of compensation would ever allow, has led to our corporate leadership having far more skin in the game, in terms of salaries, bonuses, stock options, and ownership, than they ever would have in a system with real checks and balances. Having written about this and agitated against it for years, it is clear that I do not approve of it. However, as an investor, I can take advantage of it, to the extent that I rely upon it to make corporate credit investing an even safer game than it otherwise would be if CEOs only had normal executive salaries and pay packages. In other words, with their huge compensation and incentive packages, I think corporate CEOs and senior management teams, who are also well paid and incentivized, will do everything they possibly can, pull every rabbit out of the hat, be as creative as they possibly can be, to keep their companies alive and well through whatever economic or political disasters they and we may face in the future. Regardless of what the stock market does, or whatever happens to their own company's performance and its stock, even if it has to cut its dividend, lay off employees, etc., these highly paid and incentivized managements will find a way to muddle through and thus protect their own livelihoods and future prosperity. That, to me, is the ultimate rationale for regarding credit as the go-to investment for uncertain times. The math also supports this. In an ordinary recession, annual corporate defaults that are normally in the 1 to 2% range will likely go to perhaps 5%. In a really serious recession, like the Great Recession of 15 years ago, defaults might go to 11 to 12%. With secured loans or even unsecured bonds, your likely principal recovery is likely to be about 60 to 65% for loans and 40 to 45% for bonds. So in a recession, if 5% of your loans and bonds default and you collect on average 50% of the principal, your portfolio loss is likely to be 50% times 5%, or 2.5%. In a really bad recession, maybe it will be 12% defaults with losses of 50%, or a portfolio loss of 6%. I suspect that the impact on an equity portfolio would be far greater than that in the same environment. I look forward to your comments and questions. This article was written by Stephen Bavaria.
Until next time, God bless.